Something important just came in, and you are not going to want to miss this. This just dropped, and people are already reaching out asking what it means for their bills, their savings, their Social Security, and their daily cost of living. We have got inflation news, Federal Reserve pressure, interest rate warnings, Social Security COLA updates, and a forecast that every senior on a fixed income needs to hear right now today. So stick with me. I am going to walk you through every single piece of this in plain, simple language. No confusing terms, just the facts that matter directly to your life and your wallet. If this channel has been keeping you informed and ahead of the news, please go ahead right now and hit that subscribe button. Leave a comment below and tell me where you are watching from today. I read every single one. Now let us get right into it because this is important and it is happening right now in May of 2026. Here is the situation in plain terms. Inflation in the United States is staying stubbornly high, and it is not coming down the way that many people had hoped. And that is putting enormous pressure on the Federal Reserve right now. Traders moved further away from expecting any Federal Reserve interest rate cuts, and in fact, began anticipating a higher probability that the next move would be a hike. Market pricing implied about a 37% probability of a rate increase before the end of the year. Let me pause right there and make sure you understand what that means in real terms for your everyday life. Because this is not just a Wall Street number. This affects you directly. When interest rates go up, everything that involves borrowing gets more expensive. Credit cards, car loans, home equity lines, medical financing, all of it costs more. And when the Federal Reserve keeps rates high to fight inflation, it also sends a signal to the entire economy that prices are not under control yet. And that signal ripples all the way to your grocery store. The U.S. Federal Reserve kept interest rates unchanged at 3.5 to 3.75% at its April 29th meeting. The decision exposed rare internal disagreement. 4 officials dissented, the highest level of dissent since 1992. 4 officials disagreeing at the same time. That has not happened in more than 30 years. And what that tells you is that even the people inside the Federal Reserve are not sure what to do next. Some want to keep rates where they are. Some are worried inflation could force them to raise rates even higher. And some are concerned that keeping rates too high for too long will hurt ordinary Americans who are already struggling. Jerome Powell confirmed that the April 29th meeting was his final press conference as Federal Reserve Chair. His term officially ends on May 15, 2026. He stated he may remain on the Federal Reserve Board until January 2028. That means right now, at one of the most uncertain economic moments in years, the Federal Reserve is going through a leadership change. The incoming chair is Kevin Warsh, nominated by President Trump. BofA Global Research now expects the Fed to remain on hold for the rest of this year, with 2 quarter-point cuts in July and September 2027. The data simply do not warrant cuts this year. Core inflation is too high and moving up. Barclays moved to no cuts in 2026. JPMorgan Global Research expects the Fed to hold rates steady throughout 2026, with the next move actually being a 25 basis point hike. So you have Bank of America, Barclays, and JPMorgan, 3 of the biggest financial institutions in the world, all saying the same thing: no rate cuts this year. And JPMorgan is actually saying a rate hike is possible. That is a big shift from just a few months ago when many people expected rates to come down in 2026. And it matters because higher rates for longer means the cost of living stays elevated for longer. Cleveland Fed President Beth Hammack described this as probably the 4th shock that we have had in 5 years, referencing the pandemic disruption of global supply chains, the Russia-Ukraine invasion, and tariffs. Now, the Iran war is adding to that pressure. 4 shocks in 5 years. Think about what that means for a senior on a fixed income who has been trying to keep up with prices since the pandemic hit. Every time things start to feel manageable, another wave comes. I want to say something directly to you right now. If you are feeling exhausted by this, if you feel like you cannot catch a break, that feeling is completely justified by the facts. You are not imagining it. The data backs up everything you are experiencing at the grocery store, at the gas station, at the pharmacy. It has been one thing after another for 5 years straight. Soaring gas prices have put the brakes on the spending habits of millions of Americans, hitting their wallets hard and fueling America's persistent economic inflation-driven divide. A New York Fed study found the highest gap to date in U.S. gas spending, severely curbing the purchasing power of lower-income households at the pump. That study found that the gap between what lower-income households pay for gas versus higher-income households is at its widest point ever recorded. That gap is not just uncomfortable. For someone on Social Security or SSDI, it can mean choosing between gas and groceries. Now let us talk about inflation itself, because I want to make sure you have the clearest picture of where things stand right now. Seniors received a 2026 COLA of 2.8%, but the Consumer Price Index rose at an annual rate of 3.8% in April and 3.3% in March. That means millions of Social Security recipients are not keeping up with surging consumer prices. Let me put that in simple dollar terms so you can feel exactly what that gap means. Your Social Security raise this year gave you about $56 more per month on average. But if your grocery bill went up $60 and your gas costs went up $30 more and your electric bill jumped $20, that $56 raise disappeared before you even noticed it arrived. A recent poll by ARP found that many seniors think the retirement program's inflation adjustments are falling short and that they need an annual COLA of about 5% to keep up with their daily expenses. 5%. But this year's COLA was 2.8%. That is a gap of more than 2 full percentage points between what seniors say they need and what they actually received. Social Security benefits have lost almost 14% of their value over the last decade because the inflation index used to set the annual COLA does not accurately reflect the costs that seniors face, such as higher healthcare expenses. 14% of purchasing power lost in 10 years. That is not a small number. That means if your check bought $100 worth of goods a decade ago, today it only buys $86 worth of the same things. And the COLA formula is based on the spending patterns of working-age urban employees, not retirees. It gives too little weight to healthcare costs, which are one of the biggest expenses seniors face every month. Costs for caring for the elderly at home jumped 11.6% last month on an annual basis, while medical services rose 3.9%. Seniors on fixed incomes are rightly concerned that the Social Security COLA is not keeping pace with the true impact of inflation on their living costs. 11.6% for home care costs, nearly 12%. If you or a loved one depends on any kind of home assistance, that increase is enormous and it is happening right now in your real life. I will keep covering these numbers and these stories every single day because you deserve to know exactly what is happening and how it connects to your monthly check and your daily bills. Now let me bring you some important news about your 2027 Social Security COLA because there is a meaningful update and I want to make sure you hear it clearly and honestly. Fresh estimates from analysts show the 2027 COLA could climb well above earlier projections after consumer prices accelerated faster than expected in April 2026. Independent Social Security and Medicare policy analyst Mary Johnson now estimates the 2027 Social Security COLA could reach 4.2%. The Senior Citizens League estimates based on data through April that the 2027 COLA could climb to 3.9%, or 1.1 percentage points higher than the 2026 COLA of 2.8%. The average benefits check for retired workers would increase by $81.17. Now, $81 more per month sounds better than $56 more, and it is. But I want to give you the honest context around that number because you deserve the full picture. A higher COLA for 2027 only happens because prices are running very hot right now in 2026. It is not a gift. It is a delayed reimbursement for inflation you are already living through today. By the time that higher COLA arrives in January of 2027, you will have spent months paying more for groceries, more for gas, more for medicine, and more for utilities. The raise comes after the pain, not before it. The Social Security COLA for 2027 will not be set until October, and the final figure could change depending on inflation's path over the rest of the year. So, the 3.9 or 4.2% estimate is just that right now, an estimate. It could go higher if inflation keeps climbing, it could come in lower if energy prices start to fall, and I will be watching every month and bringing you the update the moment it changes. The deciding factor for the Federal Reserve will be inflation expectations. If they continue to move higher, not only will cutting rates be off the table, but even holding rates where they are is going to be pretty tough. What that means in plain English is this. If people start to expect prices to keep going up indefinitely, the Federal Reserve may feel it has no choice but to raise rates, and that makes borrowing more expensive across the entire economy. Economists at Nationwide expect the inflation rate to peak sometime this summer at around 4.5%, more than double the Federal Reserve's 2% target. 4.5% inflation this summer. If that forecast is correct, it would mean prices are rising more than twice as fast as the Federal Reserve's goal, and that would hit every senior in this country directly where it hurts most. Inflation could potentially exceed 4% by the end of 2026. The core drivers include the lagged effects of tariffs, an expansion in the fiscal deficit, a tighter labor market, and inflationary expectations that are drifting upward. Now, I know that is a lot of difficult information to take in at once, and I want to stop here for a moment and say something that I mean sincerely. You are watching this because you care about your financial security. You care about being prepared, and that is exactly the right thing to do. Staying informed is one of the most powerful things you can do in times like these. And I want you to know that you are not alone in this. There are tens of millions of seniors and retirees across this country sitting at their kitchen tables right now, looking at the same bills, asking the same questions, feeling the same pressure. Financial planners continue encouraging retirees to review monthly spending carefully during periods of rising prices. Transportation costs, medical expenses, utilities, groceries, and home insurance remain some of the fastest-growing expenses affecting older Americans in 2026. If you have not already, now is a good time to go through your monthly expenses and identify which categories have gone up the most since this time last year. Knowing exactly where the money is going gives you more control over what to do next. For seniors on Social Security, higher interest rates can actually mean better returns on savings and certificates of deposit, as well as Treasury securities. That is one silver lining worth mentioning. If you have savings in a certificate of deposit or a high-yield savings account, the current high-rate environment means you may be earning more on those savings than you have in years. It does not cancel out the pain of higher prices, but it is a real benefit for those who have savings set aside, and it is worth taking a look at what your current accounts are offering. Now let me also mention something that is helping some seniors right now and that many people do not even know they qualify for. The Extra Help program through Medicare can significantly lower what you pay for prescription drugs each month. The Low-Income Home Energy Assistance Program, known as LIHEAP, helps cover heating and cooling costs for qualifying households. And the Supplemental Nutrition Assistance Program has a senior-specific track that many eligible people never apply for. These programs exist right now. They are funded, and they are designed for exactly this kind of moment when prices are high and fixed incomes are stretched thin. Please do not leave that help on the table. If you are not sure whether you qualify, call your local senior center or your state's Department of Aging. They can walk you through it step by step for free. And I will keep bringing you information about these programs as well as all the economic updates, because that is what this channel is here to do every single day. If today's update was helpful to you, please like this video right now. It takes 1 second and it helps more seniors find this channel and stay informed. Subscribe if you have not already, and drop a comment below telling me how the current inflation and interest rate situation is affecting you where you live. Your story matters, and I want to hear it. I will keep watching the Federal Reserve, the inflation reports, your Social Security COLA, and everything that touches your pocket and your peace of mind. I will see you in the very next update.